Greetings and Happy New Year. Hope you had a nice Christmas and a holiday season. As I'm speaking to you today, the market is testing levels from back in October 21. We believe there are a few reasons for the weakening market. The main reason we believe is the direction of the Federal Reserve policy in raising interest rates, as we've been mentioning for about 2 years now. When interest rates rise, this will put pressure on stocks, especially technology. Last week, the Fed minutes were released, which detailed that they were definitely looking at raising rates 3 times this year. As previously mentioned, the stock market, especially technology, doesn't like the idea of money becoming more expensive to borrow. Now, it's never fun to see our accounts decline in value, but we are long-term investors. Many of you do not use your accounts for monthly income. Many of you don't take distributions either. Those of you who do take income from these accounts, the lion's share of you do not take enough distributions for the fluctuations to make a big difference for your monthly income. So again, most of you are long-term investors. And for those who are listening would like to discuss how much of your accounts you might be using to supplement your income now or in retirement and how the market volatility would affect you or could affect you, please see the link in the body of this email. And right above the link, it says in bold, questionnaire. There are 13 questions to be answered. As soon as you answer those questions, we'll be alerted and Danette will reach out to you to see if you'd like to schedule a time to discuss your account. Whether you'd like to chat or not, it would be helpful for me if you answered those 13 questions, which again, you can find by clicking the link in the email below. So if you're not familiar with Ray Dalio, he's a billionaire and he runs a hedge fund. He's a hedge fund manager and he's been a lot more right than wrong over the past few years. And I thought I'd just take a couple excerpts of things that he said. Here you go. He said specifically, this printing of money and buying of debt assets has driven interest rates so low that cash and bonds are stupid to own. He notes, I think one should consider minimizing one's ownership of cash, bonds in dollars, euros, and yen. Famed hedge fund manager Ray Dalio said Tuesday that attempting to time the market becomes a fool's journey because of the unpredictable nature of things like the progress of the pandemic. Speaking to CNBC, the founder and co-CEO of Bridgewater Associates, he also argued that investors should move out of cash and into assets with higher upside potential, as the declining value of the dollar will eat away their spending power, inflation. He suggested that the fast-moving nature of events makes this very difficult, especially during a time when COVID-related headlines can spark massive volatility, as has happened recently with the Omicron variant. Rather than attempting to time the markets, Dalio suggested creating a balanced all-weather portfolio which will lower risk and provide a better return than trying to aggressively trade short-term movements, which is what we essentially do. When he commented on the Federal Reserve, Dalio said that policymakers were between a rock and a hard place, trying to decide whether to scale back their stimulus efforts or leave everything the same. We're at each other's throats now when we have all of this money and credit that has come out and there's almost a sugar high. Just imagine if we had an economic downturn, what that would mean, he said. We too feel the same way and we're watching the Fed closely. Our goal is not to time the market, but to decrease our exposure a bit to the tech positions that have become very large because of the large gains we've made over the last few years. Remember, no one has a crystal ball and can time the market. The bottom line is every one of you are long-term investors, as I said above, and we're hoping to come off the lows, which we actually got in short order today. The NASDAQ was down almost 3% and it now closed at even. So we're hoping this bounce continues so we can trim these positions down to a more reasonable percentage of your portfolio and add some more defensive names. Okay, if you could please take the time to answer those 13 questions by clicking the link in the email below, I would appreciate it. As always, thanks for listening. If you have any questions or comments, please reach out to us. Have a great day.